Hello and welcome to ShareScart. Today we are going to discuss OYO's third IPO attempt, which actually changed their story. So, 3 years ago, OYO was the startup everyone loved to tear apart. Billions raised, thousands laid off, a valuation that crashed from $10 billion to under 3. 2 IPO fillings that went nowhere. Most people stopped following the story there. That was a mistake. What is OYO actually? For anyone catching up, OYO was founded in 2012 by Ritesh Agarwal, then just 19 years old. The idea was simple. Partner with budget hotel owners, standardize the experience, manage the pricing and demand, and take a cut. By 2019, OYO was in over 800 cities and 35 countries, valued near $10 billion and burning cash at an alarming rate. Then COVID hit. Guaranteed revenue contracts signed during the hypergrowth became liabilities overnight. Mass layoffs followed. International exits. The company restructured aggressively. And most people assumed that that was the end of the OYO story. But no, it wasn't. So what really changed? FY24 became the first fiscal year in OYO's history to end with a net profit of a whopping 229 crores, reversing years of heavy losses. FY22 loss was rupees 2,074 crores and FY23 loss was 1,286 crores. The turnaround wasn't accidental. OYO exited weak markets, cut costs and stopped chasing growth at any cost. Then came the bigger move. In December 2024, OYO completed the acquisition of Motel 6 and Studio 6 from Blackstone for $525 million, adding roughly 1,500 US properties and approximately $1.7 billion in gross annual revenue. That single deal transformed OYO from a startup hospitality platform into a scaled global hotel operator. OYO's reported Q1 financial year 2026 revenue crossed 7,200 CR, up to 47% year-on-year because Motel 6 is now fully consolidated. The IPO and why this one is different. On January 1st, 2026, OYO submitted its third confidential DRHP to SEBI, targeting a valuation of $7 to $8 billion, raising 6,650 crores. And on 2nd June, the company received an official nod from SEBI. Here's what makes this filing different from the previous two. So first is all of it's a fresh issue. There is no offer for sale. Retail investors are not funding shareholder exits. They're funding debt reduction, Motel 6 integration and future growth. So that's a meaningfully cleaner structure. Current reporting also suggests the SoftBank is not participating in a sell down at IPO, which signals confidence, not urgency. The risks are real too, indeed. This is not a clean story. Running 1,500 physical properties across the US is a fundamentally different operational challenge than managing a franchisee network in India. And OYO's previous international attempts largely ended in retreat. There's also governance baggage. A bonus share proposal in 2024 would have concentrated control with insiders, but it was withdrawn after scrutiny and replaced with a one-for-one bonus share for all shareholders. The right call, but it happened under pressure. And the founder's 2019 decision to borrow $2 billion to increase his own stake from 10% to 33% still draws scrutiny from institutional investors. Now, to summarize it all, the OYO attempting to list in 2026 is profitable, operationally disciplined, and materially larger than the company that first fled in 2021. But public markets will test whether the $7 to $8 billion valuation holds, and they tend to make the test harder than private markets ever did. But you keep watching ShareScart for more such informative video, and we will bring you back another such story soon.